Morning, everyone. Thank you for joining our special market update webinar. My name is Sean Kimji. I'm the Vice President of Wealth at Alterna Savings. And I wanted to say thank you for taking the time today. This is certainly some interesting times we are living in as it relates to the markets and certainly all the factors influencing the movement of the markets that we seem to receive in the news on a regular daily basis. Before we begin, a couple of housekeeping items. All participants will be in a listen-only mode. You can submit questions online through the chat function, and we will endeavor to address all of your questions. If your question is not answered, please feel free to send an email to wealth@alterna.ca, and we will certainly get back to you with a response to your question. The webinar will be recorded and available on our website, likely in the next 24 hours. I'd like to welcome back John Bai, who is no stranger to our audience, and I'll certainly take the time to formally introduce him once again. John joined NEI Investments in May of 2019 and was responsible for the firm's asset allocation and investment strategy, sub-advisor research, and due diligence, and is a key partner in building strong relationships within our advisor community, both in the credit union and intermediary channels. He brings more than 25 years of investment industry experience, having worked for some of Canada's top financial institutions. Prior to joining NEI, John led product and investment teams at Merrill Lynch Canada, TD, Dynamic Mutual Funds, and Hollis Wealth. There, he founded and chaired the asset allocation and investment portfolio committees, led manager oversight activities, and was responsible for research teams that covered equities, fixed income, mutual funds, ETFs, and alternative products. John holds a Bachelor of Commerce degree in Finance and Economics and from the University of Toronto, and is a CFA charter holder. So, why don't we just dive right into it, John, if that works for you? When I took a look at the markets this morning, and they were a little red. Over the course of let's call it from the beginning of the year, we've seen a bit of certainly a downtrend. We've seen increased volatility, and we understand that there are many factors influencing the market returns. Some related to company performance, some related to geopolitical factors, some related to money supply, and certainly, a lot of questions are on people's minds. But I thought I would start by just asking for you maybe to give a broad overview on, what has happened, let's call it, since the beginning of the year, as it relates to the markets and what you've seen and experienced as far. And then I thought we could tackle some of the key issues that are driving some of the results we're seeing in the marketplace today.
Absolutely, Sean. Thank you very much for having me, and thank you everyone for tuning into this call. We certainly appreciate your interest in the markets and taking time out of your very busy day. So let's address what's causing this current downdraft in the markets, and it's really unusual because what you typically see is when you see a downdraft in markets, you'll see stocks trade down, but bonds trade up. But really the markets have been really fighting for significant tailwinds since the beginning of the year. And these are stories well known by your listeners, but just to repeat them. Number one, high and persistent inflation. Two, aggressive central bank rates as they struggle to keep long-term inflation expectations pinned into their targeted range of 1% to 3%. And the way that they're doing that is by aggressively increasing their policy rates. Three, we had the war in Ukraine, which was really one of those black swan events that have helped stir inflationary pressures, as the Russian-Ukraine region is one of the largest exporters of raw materials such as energy and commodities and food agriculture globally. Number four, we've seen also in China, which is traditionally one of the big growth engines of the globe, are struggling with lockdowns in order to control COVID in that region. And so with these four very strong headwinds in the marketplace, we've seen both equities and bonds respond to that. As I said, it's been very, very unusual. The first quarter, we saw deep drawdowns in both stocks and bonds. But I think what's really interesting thing here is that we're beginning to see a change in the marketplace. As I said, they were very positively correlated. What I mean by that is that when stocks went down, or when bonds went down, stocks went down, and when bonds went up, stocks went up. And since Monday, March 9th, I'll be very specific, and I'll almost say at the exact time, probably about 7:10 a.m. Pre-market. We saw the 10-year U.S. Treasury yield peak at 3.2%. And since that time, we've traded below that, which is interesting. But even more interesting from my perspective is the fact that we've seen the negative correlation return. So that means when stocks went down, bonds actually went up. Why is that important for me? Again, it signals to me that the market is now moving on. We were very focused, Sean, on the first two segments of those headwinds for the first 4 months of the year, which is high and persistent inflation and rising central bank rates. I think that's largely discounted in the marketplace today. We're now shifting. Our investors are now shifting to a new narrative. That new narrative is slowing growth. And when investors are worried about slowing growth, they typically, when they sell equities, they go to safer havens such as bonds. And that's exactly what we're seeing here. And that's pretty interesting for me, because not only does it signal a new segment of the marketplace, it also signals that more diversified assets, like a balanced portfolio, have places to hide. Whereas in the first quarter, investors really had no place to hide.
No, that's a great point, John. And I'd like to touch back possibly a little bit on the inflation and interest rate discussion. It's very central to a lot of our members. It's no surprise if you go and try and fill your gas tank today, north of $2 a liter. Price of groceries has certainly gone up. And I think, a lot of concerns around inflation are, people are feeling it in real terms. But then we also understand that the central banks are raising rates, and we understand that rates continue. There is going to be an upward trajectory on rates to combat inflation. Perhaps you could provide us your thoughts on, are we reaching a point where inflation, is going to be under control? Do we see that inflation perhaps will temper a little bit? And how long can we anticipate to be, in your view, in a rising rate environment? And will that continue throughout the year?
Yeah, it's a good question, and I feel the pain too. I filled up my car on the weekend, Sean, and I'd say in the pandemic days when nobody was driving, that gas tank would have cost me probably $65-$70. Now it was $150, and so certainly was certainly a very, very shocking gas bill on the weekend. And again, talking to my wife, and again, I do defer a lot of the shopping to her, but the price of avocados, she tells me, has gone from like $3 a bag to $10 a bag. So again, this energy and food prices is very, very worrying for many Canadians. And and I think that the central bank really understands how it has a disproportionate impact on a vast majority of Canadians, and so they're very focused on making sure that they get this inflation under control. So I would say a couple of things here. Number one is that that central banks, having inflation is actually really is a good sign. Really, we know how to handle inflation, which is raise interest rates, slow economic activity, slow down demand, and that typically will deal with it. What's more worrying for the markets, and just taking a step back, that the markets really and central banks really don't understand fully how to deal with a deflationary environment. That is, you don't have enough economic activity to support. And so when you're in this deflationary environment where Japan has been for decades, since the 1990s, where Europe has been since the global financial crisis, those are really tough economic environments. And so when we had this shock during COVID, the governments and the central banks did everything that they could to ensure that there wasn't permanent economic scarring from that pandemic. And as a result of that, they flooded the system with excess liquidity. They flooded the system with what we call helicopter money, sending out checks to households to maintain that demand. And again, that's worked better than expected. We had this incredible surge in demand for goods, and so the manufacturing with the broken supply chains due to COVID, were not able to keep up. The good news is that we're starting to see the effects of that. The central banks in Canada, Canada is actually a leader, and this is one of the first major central banks in the world to target inflation over the last 30 years, and they've done a very good job at that. And if you look at Canada's track record of inflation over the last 30 years, it's pretty pinned at around 2%, down lower 1%, up to 3%, but pretty pinned at 2%. And so, it's interesting here that as we begin to worry about slowing economic growth, at least the markets are worrying about slowing economic growth. For us, we actually aren't worried about it. We actually welcome it, because as we slow down the economy, we reduce those inflationary pressures. People will buy less. And again, the Canadian economy is very sensitive to the housing sector, much more sensitive than other. So for instance, the US. And so, one of the things that we're going to have to watch very, very carefully is that, and we're already seeing housing sales begin to tail off. And so we expect with our CPI here, 30% of our CPI basket is housing prices. As higher interest rates take their effect, cool off the housing market, then again, you'll see a natural decline in inflation in this country. And so so to answer your question, that's a long-winded way, Sean. I apologize, but my underlying message is that inflation is a signal of a strong economy, and we need to slow down the economy to get inflation under control. And I think that we're along the path yet. And what we're really worrying about is, will the central banks overshoot?
No, that's great. You mentioned slowing economic growth, perhaps might be a good thing. And I'm just curious, as many members might be questioning this as well, is when we have a slowing economic growth environment, could that lead to muted returns on investments, and could that impact portfolio returns as well?
Yeah, absolutely. Again, the two things that we watch, as we start to forecast our market assumptions is economic growth, because economic growth impacts earnings growth. And clearly, as you slow down economic activity, your earnings growth begins to decline as well. And so, from our perspective, but having said all that, when you run economy too hot, and then inflation gets out of control, and then we have all you add is this higher cyclicality to your economic forecast, and that's very, very difficult. You get the boom and bust scenarios, which is even more difficult for businesses, economic activity, and the markets. And so again, what we're trying to do is yes, you are going to see rates of return start to diminish. I mean, you think about what happened in 2020 and 2021, where we saw these excess returns over 20%. Again, that's not sustainable. Market returns over longer periods of time have averaged around 7 to 9%, or very high single digits. And that, over the next 2 years, we're expecting earnings growth to be in that, mid to high single digits. PE ratios have declined here. So we do expect market returns to moderate over the next 3 years. But we think that moderation is to more longer term levels and still positive, and not return to the 20% plus type of excess returns that we've seen over the last 2 years.
Thank you, John. I mean, when we certainly saw a lot of volatility in the last few years, when the pandemic first became widespread, the market certainly retracted significantly in the early days, and then we saw the corresponding rebound on that. There were a lot of individuals who may have said, I'm not comfortable in these markets, and could have lost the upside of those gains, shortly thereafter. But I do want to go back and take a look at, supply chain issues. We've heard this theme in the past. You mentioned China having, a zero COVID policy and lockdowns continuing over there. Do we see any lightening in any of the supply chain concerns? Because, if we look at, the inflation discussion, we look at, the challenges with getting goods to market. Supply chain issues have contributed to some of the price increases. Where do you anticipate the supply chain conversation easing, if at all, in the next quarter or by the end of the year?
Yeah, it's a good question. Again, one of the key drivers to an easing supply chain, like right now, and when you look at supply chain, there's really two factors, like everything. I guess I'm going to sound like an economist, but there's a demand and supply issue. And when you have a situation where you have excess demand, where demand is stronger than your ability to supply to meet the demand through supply, that's when you have real issues, and that's where we've been over the last 2 years. And so one of the things that we've been talking a lot, and Sean, I know that we've talked on this call about, is what we are seeing is a change and a shift in our spending from goods to services. And again, and what that means is that, as the economy begins to open up, we're less focused on buying things that we want around the house, and more interested in doing services like travel once again, and hotels, and eating out, and doing things that we just haven't had over the last couple of years. And you're seeing that actually in the inflation numbers, that the goods inflation, is beginning to moderate. Where you're seeing an acceleration is in air travel, for instance, and airline tickets are increasing dramatically, over 30% year over year, and that's just because we've been penned up for so long. And when I say this and I talk to people, they say, "Oh yeah, when I just booked my summer vacation, and I don't care what I'm paying, I am getting out of the city." And so so the services industry have been able to increase their prices and still meet with demand. And so that all of that actually begins to ease pressure on the manufacturing sector, because we're not buying as much stuff, and we're spending it on more services. That will give the supply chain more time to get their house in order. And again, you're absolutely right. It's been discombobulated over the last couple of years, and we just need to ease demand. The ease in housing related, as interest rates go up, and we buy less fixed goods and expensive goods for the houses, that will also help reduce demand to get supply chains back to normal. Again, as we begin to dissipate, knock on wood, the effects of COVID, and hopefully we won't see those dramatic shutdowns in the factories in China. So again, we're very hopeful for the second half of the year and into 2023 that with lower demand, more supply chains more aligned, and less COVID disruptions, that those supply issues will begin to work themselves out through the system.
No, that's great, John. Thank you. I wanted to maybe shift gears to take a look at some of the geopolitical influences that are impacting the market. We all know that there is a current war in Ukraine that has been ongoing now for some time. Recently, we've seen that Finland and Sweden are looking to join NATO now, which could potentially further increase the conflict. Again, it's a best guess at this point. But Ukraine is a producer, as you mentioned, of raw materials in certain goods, and all of those are having an impact on the supply of natural resources and the price of oil. What are your thoughts on the crisis, the impacts it has, and if it does escalate, how would that influence the markets?
Yeah, the unfortunate, again, we did not need to see this war at this moment in time, for sure. It's actually quite maddening, but given the fact that, it's there, really not seeing an end in sight right now, in terms of, a good out for Putin. But we are ratcheting up, and I think this is right. Trying to isolate that economy to try to cut off the funds that they receive to fund that war. Again, this isolation of the Russian economy is really unfortunate, for the peoples of that country. But again, the point here is that, the only way that we can go and put pressure to de-escalate that war is to increase economic sanctions and not let that economy get access to the dollars that they need to continuously fund that war. So if that war continues, again, again, we'll continue to put pressure on raw materials. And it's going to get worse. I think developed countries like ourselves, Canada and the United States, we're a little bit disconnected from that, because of our geography. In Europe, they're feeling the full effects of that, just because of their proximity, their economic ties to Russia and Ukraine, as well as their dependence on Russian energy sources such as natural gas and oil. Here in North America, we're less connected, and in Canada, actually, given our geography, we have a very similar commodity backdrop, and so our economy will actually benefit from rising wheat prices and commodity prices and things of that sort. In fact, actually, there's a good and bad news story, but if you look at the Bank of Canada Commodity Index, which tracks, I think it's 24 or 26 of the commodities produced here in Canada, that commodity index has doubled since the summer of 2020. And so, typically that bodes well for our economic growth here in this country. So, the bottom line is that on a geopolitical side, increased geopolitical in Russia and Ukraine is not good. But the one thing that we are seeing is the strengthening of the Western alliances, and I think that has been good, and we'll see where it goes. But again, hoping for a quicker resolution, but unfortunately not seeing anything right now.
Yeah, no, and we certainly, hope for a resolution to come through that and not increase conflict. I had a question come in, John, and I thought I'd maybe, pick your brain on this. Is, how can we address the climate crisis and continue to have economic growth? Are they divergent, or can it be supported? Can you have economic growth and still address climate concerns? What are your views on that?
Yeah, it's a great question. One of the critical things that, and I think this is a really, really important point to make, is that if you looked since the 1990s, Canada's, well, globally, the G7, let me start off with the G7. You've seen a very strong disconnection between economic growth and our carbon footprint. That as we continue to grow, the G7 countries have been very successful at growing their economy and reducing their carbon footprint at the same time. And I think that's a really, really important point to make. The one exception actually is Canada, where we're the only country in the G7 that has significantly increased our carbon footprint over that time period. And so, we do have to do a better job of that. And again, obviously a big part of that is the oil production that we have in the Western provinces. I was looking at some economic data recently on that front, and capital investment into the energy sector. And typically what you see is when you see oil above $100 a barrel, you see that lots of investments go into that field to increase production. And that's why you see the Canadian dollar increase. I mean, that's what we call the Canadian dollar a petrocurrency. This time around, you've actually not seen that. And I thought that was quite odd. And so I looked deeper into the numbers, and what you've seen actually is that that fixed capital investment into the oil and gas sector has actually been a net drag on the Canadian economy since 2015, which is absolutely shocking. But it goes to speak that, as a Canadian economy, we can't depend on the energy sector to drive economic growth over the next 10, 20, 30 years. We really need to diversify our economy and really focus on economic growth that doesn't not only doesn't increase our economic footprint, but does the exact opposite, helps reduce the globe's economic footprint. So a good example of that, for instance, is investments in carbon capture, utilization and storage, or CCUS. And Canada actually has an opportunity here, for instance, to be a global leader in carbon capture and storing that carbon in the vast caverns that we have underneath our ground. And so, again, if we can go and continue to focus on these technologies as emergent technologies to help the globe reduce its carbon footprint, we have an opportunity not only to grow the economy, not only to pay for high-paying jobs, but also to reduce the carbon footprint on a go-forward basis. And so, if we can continue to go as business as usual, and that meaning that we depend on high consumption, high energy production on our economic growth, then that's incompatible with climate change and reducing the effects of climate change. But if we depend on these emergent technologies, other things that we can be doing, for instance, Sean, one a big source of carbon releases into the atmosphere is inefficient buildings. Right. So if we spend more monies on increasing the energy efficiency of our houses and the office towers that we have, again, good economic growth, it reduces our carbon footprint, pays for high-paying jobs. We just need to be smarter about where we drive our economic growth on a go-forward basis.
No, and that's a great answer, John. I mean, there are many things that we can do as a nation to help, reduce our carbon footprint, and still have economic output. Really, really important there. So thank you, and appreciate that response to that answer. So, John, markets typically are forward-looking. We've certainly seen the downturn in the markets. And you've hinted, I believe, or in some of your earlier comments, that we're possibly looking at a better half of the year coming out of the current situation we're in. What would your forecast be for the remainder of 2022? And I guess what are on the minds of a lot of our membership is, will the markets trend positive at some point? What are your thoughts on that?
Yeah, I wish my crystal ball was 100% accurate, Sean. But I'll give it my best guess, and I think this is a really important point. There's no question right now that the markets are under extreme pressure. But again, we're starting to see the stress levels that we have a lot of sentiment indicators that we haven't seen since the bears of March 2020. So, for instance, if you look at the fear greed index, many fear greed indexes out there, those are at cyclical lows. You look at there's this survey, AAII, the American and Institutional Investor Surveys. Their bull bear indicator is at bearish lows. You look at the put call ratios, you look at 52-week high versus 52-week low, you look at market breadth, all of those measures point to extreme bear market sentiment. So right now, we're seeing an environment where, given the economic headwinds, we still haven't seen quantitative tightening from the central banks yet, in the U.S. that is, there's just a lack of buyers in the equity markets right now, and that low liquidity is causing the volatility that we're seeing today. We think that, as the market starts to get confidence in that inflation has peaked and that it's on its way down, and we are starting to see that, for instance, in the five-year, we call it break evens, and so that means that what the markets are anticipating over the next 5 years, 5 years from now. Those inflation expectations are starting to go down. The mantra from the bank saying that they're committed to fighting inflation, and that's having an effect on keeping long-term expectations for inflation down. I think you'll see confidence return into the markets. As I said, Sean, valuations, is a very important part of what we look at the 2020 market highs. S&P 500 multiples were in excess of 25 times. We're now down closer to 16, 17 times. Again, in line with long-term averages. So, not really extreme on the bearish side, but certainly where at much more reasonable levels. And so, I think that by the end of the year, we should see a return of confidence in the markets. We've seen a return of buyers into the markets. We'll see some of those really bearish sentiments indicators begin to trend back up. And I think we could be surprised to see how fast this market can bounce to the top end of the range. And so again, that's our base case scenario. All of that will change, of course, if we do think that there's a recession. And so right now, a recession is not our base case scenario. We do think, and most people think the probabilities of a recession in Canada and the US are around 30%. And we would agree with that. The employment situation that we're seeing in Canada and the US, Canada is actually better than the US. We're at pre-pandemic highs. Our unemployment levels are at record lows. Hours worked are better than where we were pre-pandemic. And so, given the strong labor market, given the strong balance sheets that we're seeing in the U.S. consumer and Canada, a little bit more worried. Our debt rates are a little bit high, Sean. And so, we just have to be a little bit more disciplined here as interest rates go up to ensure that we don't get over levered, because it could be a little bit rocky here for a little bit. So, we are hopeful that by the end of the year that we'll see more market conditions return, but for now, the diversified basket of stocks and bonds, which didn't work in the first quarter, is now starting to work.
Right, great. And we've seen market dips in growth, many times throughout history, whether it was the tech bubble, the credit crisis, the pandemic. And, when I talk to members and I talk to other colleagues, people tend to tell me this is different. This is different than anything that's happened in the past in terms of a market cycle or influence that's, shocked the market. Is it really though? And I'll put that to you, because every time we see something, it's considered different. So is this just part of the market cycle?
Yeah, famous last words. This time is different, and you saw that in the dot-com bubble. We saw that in 2021, where the companies like Netflix and Peloton could never go down. So in many respects, Sean, it's not different. That the markets are cyclical, and during down markets, again, March lows, there are many people who wish that the people who sold wish that they got in at the March lows. 08, 09, another great opportunity. And so when you see these really deep pullbacks in the markets, that's when fear is at the maximum. But at the same time, that's when when good money is made. Just ask Warren Buffett when he's an active buyer, and he's starting to become more active now. And so again, market pullbacks are opportunities to build wealth, not destroy wealth. And so, but you have to be participating in the markets to do that. What I will say is that I do think some things have changed. Again, some of the things that I think have changed is that we spent the last 40 years in a downward sloping inflationary environment. We spent the last 40 years in a downward sloping interest rate environment. We spent the last 40 years in increased global trade and global and geopolitical stability. And I think that a lot of those trends have been broken. As again, in the sense that for instance, your earlier question on climate change, that's going to be a big theme over the next 30-40 years. And climate change is as we start to see more and more severe natural climate events like we saw last year. I mean, last year, and I think I mentioned on this call that we've seen Canada's most deadliest climate or natural disaster in the heat domes. We also saw Canada's most expensive in the floods. So that climate change is going to increase volatility for the economy. It's going to, as we start to bring supply chains closer to the end consumer, that's going to increase costs at the margin. And this geopolitical stability that we've seen, we're already seeing kinks in that. And so it's always a very uncertain environment as people try to return to the good old days, and we become much more polarized because there is fear definitely as we start to deal with different issues that we haven't had to deal with before. So all of that's to say is that I do think that net selling at the bottom end of a trading range is always from my perspective not a great idea. I'd be more inclined to buy. I think we're closer to the bottom than the top, absolutely. And I just think that we need to stay disciplined. But I do think that some things have changed, and as investment managers, we need to be cognizant of those changes and to say, okay, well, how do we use that change as opportunity to buy companies that are taking advantage of that? And so I do think that active management in this environment over the next 10, 20 years is going to be much more important than it has been over the last 10, 20 years because of those trends.
Thank you, John. And I guess so a question related to your answer there is, what kind of guidance would you give to an investor who is perhaps looking at their statement, looking at increasing rates, maybe the security of a GIC? What are your thoughts and guidance would you provide to an individual there? And I believe you touched on it a little bit, but perhaps you can expand on that a little more.
Yeah, again, I think that this conversation is probably best had with a financial advisor that has very specific information about a member's needs and where they are on their balance sheet. But I will use very general thoughts from my perspective. I think that real returns are a really important concept here. That if you may be buying a 3% GIC, but in a inflationary environment of 6 to 8%, you're actually losing money. You're not even maintaining purchasing power with that. And so over longer periods of time, again, the markets have shown that the better place to build purchasing power is through equities, not through GICs. And so, again, I just, I'd use that, as a benchmark. But again, as I said, most individuals' situations are different, and I think this is why you need to be talking to a financial advisor. But again, I think that it's tempting to buy a GIC rate and say, okay, I don't want to deal with all of this volatility. But it's really important to understand that at the end of the day, what purchasing power are you getting or losing as a result of these investments? And so it's an important conversation. It's a nuanced conversation, and probably one best had with their advisor.
And I think that's a very important point. A lot of times, we do see reactions based on emotional conditions in where the individual might see a shock to the market, react to say, I'm not comfortable, only to perhaps regret the long-term strategy that was laid out in front for their financial plan. So, certainly that is very, very important. John, any final thoughts that you would like to convey, on how NEI is certainly, adjusting to the conditions in what changes or strategies you're employing?
Yeah, I think that right now, the most important thing for our members to keep in mind is patience and discipline. It's very, very difficult in these periods of time when you're seeing extreme red on your statements that now is a bad time to be invested in the markets, but now is actually the best time to be invested in the markets, because you want to be investing when markets are down, not when markets are up. And so I think there's tremendous amount of opportunity here. We've been spending a lot of time talking to our managers, that are sub managers, for instance, Impacts. Anyways, I don't want to keep naming the names, but again, what they're consistently telling here is that with this broad sell-off, there are a lot of great names that they're looking at right now. And just like in April of 2020, they're getting their shopping list out and looking to buy some really good names that they haven't had a chance to buy in a long time. I think one manager put it, and it was quite funny because I've never heard this expression before, but they're lacing up their buying boots, and so they're actually quite excited about some of the market opportunities that they're seeing here, given the trends that we think will be driving the markets over the next 3 to 5 years. So again, that would be this is where fortunes are made. Requires fortitude, and again, having that patience, that eye on your long-term plan, and the discipline, that then I think that these are the times when you need it. And these looking back, when you see these sharp market drawdowns, history has taught us that these have been very, very good times to be investing, not the opposite, to be selling your investments.
Yeah, no, I completely agree with you, John. And what I would encourage all of our members to do is to speak to, a financial advisor or wealth advisor. You can certainly reach out to us at wealth@alterna.ca to have a discussion, to receive some counseling on, the investment strategies. Every individual situation is different and unique. And so I would strongly encourage you to have that, personal, confidential conversation with one of our wealth advisors. With that, John, I wanted to thank you very much for your time today, to certainly appreciate the insights on the market, the factors influencing it, and the positions that NEI is taking to help our members with their financial returns. Thank you very much, everyone, for attending the call. Again, this webinar will be posted in about 24 hours. If you have additional questions, you can send them again to wealth@alterna.ca. If you'd like to speak to a wealth advisor, again, the same email, wealth@alterna.ca, and we will reach out to you. Thank you very much, John, and this concludes our webinar.